Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. John Cochrane, to everyone, I think most people know you from your work in asset pricing and your previous role at Chicago University. You're now at the Hoover Institution and write the blog, The Grumpy Economist. Maybe we should kick off with why start that blog and why The Grumpy Economist?
The blog, I was writing, I got more involved with policy affairs and what's going on in the world, and I was writing op-eds, and I found I had lots of opinions that I thought, I felt like sharing with the world, so why not start a blog? I had done some previous sort of essays that I put on a website that attracted some attention, but I felt like doing it more regularly. So blog at the time was the natural way to do it. The Grumpy Economist occurred one Sunday morning. I was reading Paul Krugman's column in the New York Times and coughed, splashed down my coffee, and said something intemperate about how silly it was. And my children thereby called me the Grumpy Economist for my reaction there. But I'm not a grumpy person in general.
That's quite funny. I think Paul Krugman does know how to wind up a lot of people. I don't know where he stands on some things. He's a big proponent of MMT.
That's blood pressure.
Oh, yeah. He's a big proponent of MMT. I know that you're also not such a proponent. Is that also something that gets you frustrated with the way that economics has almost changed today?
I think, in fairness to Krugman, he's not a proponent of MMT, although it is fun for me to watch Krugman and company be passed on the left and horrified. No, we didn't mean deficits that big, just sort of big. No, not really. MMT is not taken seriously at all in any among academic economists and so forth. It's a very popular thing, and it justifies a set of spending initiatives. But I don't think that's actually one where I'm frustrated with a lot in economics. But the reception of MMT has been, if anything, I think it's just been about right. Serious economists have thought about it, read it, commented on it, said there's nothing here, and moved on. So, there's a Flat Earth Society, there's an MMT Society, it's a free country, and that's, in Congress, they take it a little more seriously, but they take a lot of crazy stuff that comes out of Harvard seriously too. So,
Well, I guess the danger is there's these popular narratives that go alongside some of these ideas, and it's coming across all parts of not just economics, but even finance now. And the way central banks are operating is purely narrative driven. It's always the perception of wording. Action doesn't seem to really matter anymore.
Well, that's actually more frustrating because it's serious people doing it. Now, there's been crazy stuff in economics all along. Tariffs, I think Adam Smith figured out that was a bad idea in about 1760, and nonetheless, we're still basically, our public policy is stuck in the mercantilism of about the 1580s. So that's crazy. The Fed is, the central bankers around the world live in this kind of narrative world where they can push all sorts of levers and exploit all sorts of frictions that nobody really understands. And they've assigned themselves a very grandiose place at the center now of directing the whole financial system and now stopping the seas from rising and the planet from warming and social racial justice and God knows what all else. Good luck to them with that. Well, not good luck to them. They ought to stick to what they know how to do.
Well, that's I think a fascinating place to dig into. I don't know where they started to transition away from their primary role around price stability and unemployment and so forth to all these other issues. They haven't done a very good job in inflation, and they haven't really done a very good job on forecasts just generally.
They did a great job on inflation up until about 2 months ago. And, if I were a central bank chairman just before COVID, and I saw unemployment rate at like 3.5%, the lowest unemployment rate of blacks and minorities and other disadvantaged groups ever, inflation stuck around 2%, I would have put up a mission accomplished banner, and that would have been the end of that. But actually, what you're seeing now, I think, is a outgrowth of 2008. When central banks took on extraordinary measures, started doing all sorts of stuff, and buying assets, propping up asset prices, bailing out banks, bailing out right and center, and Agran, this larger role, kind of got stuck. It became part of what central banks do. Don't think of central banks in terms of interest rates and money supplies anymore. They're in there telling every big bank what to invest and what to do. So then by the 2014-ish, they had thought of themselves. They started thinking of themselves not just as inflation and unemployment interest rates, but in terms of managing the credit cycle and making sure there wouldn't be booms and busts and just sort of like somebody who runs a dam, letting just enough water in at the right time. Of course, they talked a lot about it, but they got themselves, they were the only competent person in the room in 2008, but then they got themselves in this idea that we're there to run the whole financial system. In the pandemic, then this exploded, and they also, they want to take on climate change and other causes. Well, you're a 2-year-old with a hammer, everything starts to look like a nail. So you've got these extraordinary powers, and who wants to go to Davos and say, well, what I do is I worry about the mark-to-market requirements on swap contracts at broker-dealers? Or do you want to say, I'm in there to fight for social justice and save the planet? You can see that imperative, which is, it's taking over all of our institutions. So the IMF is deep into climate change, inequality, social justice, spending money. The IMF, the BIS, the OECD, the European Central Bank, the Bank of England, they're all way ahead of the US Fed on this move.
It's an incredible time because you'd think that this is where you would maybe potentially extend your powers if everything was going well in the economy, maybe start to expand your remit. But there are, as you mentioned, there's still some very big problems around the amount of debt in the system. Inflation may be low in the official terms, but you've still got massive asset prices, which is driving a lot of this inequality. And I would say the central banks are a big part of that.
Yeah, and it's not like I've got great successes on, the 10 years of stress testers and we're going to manage everything and make sure no risks are taken and nobody ever loses money. None of the stress tests ever said, what if there's a pandemic? Gee, have we ever had pandemics before in human history? They completely blew this one. And then every promise made in 2008 just got broken. They bailed out money market funds. That ought to be like the simplest thing in the world is to fix money market funds so they don't need a bailout. Bailed out municipal bonds, corporate bonds, the airlines, and so forth. So they're coming off a grand failure of this. We're going to see all the risks ahead and regulate ahead of it. And then what are they going to do? They're going to see even more risks ahead, the climate and justice risks, not even thinking about cybersecurity, another pandemic, crop failure, war, all the things that have occurred over and over again in human history.
I'm curious around, the amount of money that's been thrown into the system, and really there's a perception now that nothing will ever go down for long. Any opportunity of any losses is just another buy the dip style moment. I'm curious around what sort of moral hazard have we now brought into the system?
That's at least in 2008. Central bankers, Congress people said, look, we got to throw money at this problem, but we understand throwing money at this problem brings about moral hazard. People will lever up too much. They'll count on the bailout. We'll got to do something about it. And they did the Dodd-Frank Act and all the regulatory stuff. Granted, I don't think that was the right answer, but at least they had the decency to think about it. No one's even talking about it now. Now it's just pat ourselves on the back. Hey, COVID came, we threw $5 trillion at it. COVID went away. What wonderful people we are. And I think you're right. You'd be a fool to keep some extra cash around to wait for the dip, because in any event, now we're not just bailing out individual institutions. The Federal Reserve, the corporate bond thing, I think, was really a crossing of the Rubicon. In Mario Draghi style, we're going to do what it takes to make sure corporate bond prices don't go down. So corporate bond investors aren't going to lose any money. Well, that's nice. So much for any incentive to keep some money around to buy corporate bonds on the dip, as you said. So it's a grand put option. Now, I don't think, in terms of just straight money, that's not, the buying treasuries isn't as significant as people think. I don't think the Fed is causing a bubble in asset prices as much as other people do. I'll give them that one. But certainly the moral hazard that It's perfectly clear in the next crisis that $10 trillion is going to get deployed to make sure that nobody ever loses any money. And soon, why? So what's wrong with that? Well, sooner or later, the firehouse burns down. Sooner or later, a crisis comes along and Uncle Sam says, okay, bond markets, we need another $15 trillion, whatever it is, to throw around stimulus money and bail everybody out, and it's not there. And then you have, the best world of all is when no one's counting on a bailout and it comes. The worst world of all is when everyone's counting on a bailout and the bailout doesn't come. And that will happen sooner or later.
I'm curious then, where do you sit in terms of the inflation deflationary camp? Because I can see from your discussion there are two different ways that can go, right? If the government decides or the central banks decide that they're not going to continue to fund this, that's pretty deflationary. Or they just keep putting more money into the system and hope for the best.
So I'm very careful never to make forecasts, so you can't prove me wrong. And I do think we're on a dicey moment where inflation could break out, and the dangers are right there. The monetary policy, the new monetary policy framework announced by the Fed, reads like a parody of all the things that they did in the 1970s that we learned in graduate school you shouldn't do anymore. Wait for inflation to get really bad before you do anything. Try to push unemployment down by allowing inflation to go big. That this is exactly what they were accused in the 70s. Now, the central issue is, when do people start? Inflation, expected inflation kind of begets inflation. So there's this anchored expectation. Now let's try to unpack that so it's not economic language. If you know that there's going to be inflation next year, you're willing to pay a higher price today. And if you know there's inflation going to be next year, you're a store, you're going to raise your prices today. So when people start to expect inflation, you get inflation, as well as when the Fed is pushing on things. So I think this breaks out when people change their minds. Right now, most people say, we're going to have a little bit of something, like the Fed says, it's going to be transitory. And then in, a year or two, we'll be back to 2%. Now, and in that case, then it likely will be transitory. And in a year or two, we're back to 2%. But if people lose faith in that, then it explodes. And then you got a real problem under your hand. Now, what causes people to lose faith? Why do people expect inflation to always be 2%? The Fed says we have the tools to do something about it, and that they bought a lot of credibility in 1980. Now I can tell that's long before you were born, but I was around. Yep. And let me remind you what 1980 looked like. Inflation got really out of control, and the Federal Reserve and central banks around the world jacked up interest rates to 20%. 20% interest rates caused a massive recession with big unemployment, but that brought down inflation. So what is the tool? The Fed says we have the tools. They won't tell you what the tools are. What is the tool? The tool is a willingness to replay 1980 if that's what it takes to get inflation under control. Now, do you think our central banks will really do that? When people lose the faith, when our central bank is loudly saying what we want to do is low interest rates forever, climate change, inequality, so on and so forth, the chances that they would promptly raise interest rates, causing a recession if needed to contain employment, to contain inflation. When people lose the faith that they're going to do that, then their job is harder. And we have now, it's not really about central banks. Our real problem is massive debt. Now, even in the 1970s, we didn't have these debts. The debt to GDP ratio in 1979, when inflation peaked, was 25%. It's 100% now. So we are on the cusp of a debt-fueled inflation that central banks can't do anything about. Now, when does that blow up? It blows up when people expect it to blow up. A financial crisis and inflation is like the Spanish Inquisition. No one ever expects it, because if you knew it was coming tomorrow, it would happen today. Now I think why are people lending money to the U.S. government at 1.5%? What's up with that? Well, they still have the faith that sooner or later, after they've gotten fighting about everything else, they will pay back this debt. Once they lose faith in that, once they lose faith that Congress is willing to raise taxes and cut spending, and it's got to mostly coming out of cut spending, if inflation blows up, well, then you lose those expectations. And that one that the central bank can't even do anything about. So I think there's reasons to worry. I'm not forecasting inflation, but you can see we're on a slippery slope where when people start to lose faith, the inflation will get bigger. You'll hear lots of it's all temporary. We have the tools, grand speeches out of central banks. It comes too late. People lose more faith and it kind of spirals out of control. That's possible.
How much do you think the comparison between what's happening in the US versus what's happening in Europe is allowing the US to have a lot more runway?
Oh, what's going on in Europe that's different?
Well, exactly.
we got rid of COVID quicker, but they're growing more slowly. They've already passed the Green New Deal. They call it the Green Deal. Nobody knows about it yet. Their central bank is out doing this stuff. They still have sort of deflation. I mean, the big problem I see in Europe is this more secular one. Europe got stuck in very slow growth. And American tourists don't realize it because they go to the pretty parts of Europe. But European income per capita is 40% lower than that in the US and has been stuck there for decades and getting worse. Now, that's about microeconomics. That's about high taxes, difficult to be an entrepreneur, starting new business, sclerotic labor markets, all the sort of classic microeconomic things that make an economy have sand in the gears. And it's really sad. I really hope the European Union, free trade, all that sort of stuff, but that didn't spark it. Europe's problem is a lot of it looks more like Italy than it should. And Italy, it's a wonderful country with an economy that hasn't grown at all since the year 2000. That's a tragedy.
Well, that's part of the thinking that why the US is able to get away with such low interest rates at the moment, because they look to the rates that you'll get in Europe. It's pretty terrible. And even for European pension investors, it makes more sense potentially to invest in the US.
Well, and if European interest rates are even lower than US interest rates.
Yeah.
Now, in part, low interest rates. Interest rates aren't really that much to do. Real interest rates don't really have that much to do with the Fed. Real interest rates come from the economy, especially over a period of years and decades. And I view low real interest rates in part as a consequence of slow growth. I mean, the US's growth ain't great either. It's just better than Europe. But the US, really, our growth around the year 2000, our permanent growth rate fell by about a half. It's a tragedy. That just means it takes two generations to do what you used to do in one generation. Low interest rates come with low growth. If you're in a low growth economy, low productivity, too much regulation, too much taxes, there's no reason for businesses to invest. So they don't, the savings is more than investment and interest rates go down. So I view it largely as a consequence. Unfortunately, I'm a macroeconomist, but unfortunately, most of the real answers are microeconomic. They just always seem so obvious that I chose not to study them. No,
but it's interesting also, you talk about sort of lower rates begetting even more lower rates, right? I think that situation, I don't think people really understand. The assumption is that if you lower rates, the economy should really take off, but it can actually have the reverse effect.
Well, like all prices, low rates can be a sign of low growth as opposed to an inducer of high growth. Same like property prices. Is it good to have property prices high or low? Well, high property prices are a sign of a prosperous place, but of course, given the place, lower prices are always good to buy stuff. So interest rates are the same way. Low interest rates are a sign of bad growth, but they can also help to spur more growth if they're lowered. But the central banks don't have as much control over financial markets as everybody seems to think they do. I really don't, the cost of capital is the cost of capital. It's from saving, investment, productivity of the economy, a reasonable tax system, the chance for entrepreneurs to make good companies and start investments. That's what really drives financial markets.
How much do you think that the narrative management of both governments and the central bank plays really a role in telling people that things are okay and we've got low rates, but don't worry, economic growth is here?
Narrative management and forward guidance and sort of public psychology. I think that's the opiate of the policymaker. We've seen catastrophes with our Centers for Disease Control and Food and Drug Administration trying to manage psychology. They held back the vaccine for 2 weeks because they wanted people to think they were taking it seriously. They stopped the Johnson & Johnson vaccine as an effort to manage public psychology to make people think that they were making it safe. Instead, they had the opposite. And our central banks are deep into this. They call it forward guidance. And they think that sort of speeches about what we're going to do in the future is the central way to stimulate the economy. They don't move interest rates. and they keep buying the same stuff, but they give lots of speeches about the future. And they take this seriously. Forward guidance is the key policy tool. Now, only people inside the Beltway can think that speeches from politicians have an enormous impact on what people do. Get out a little bit, drive around the country. When you buy gas at a gas station in the middle of nowhere, ask the person behind the counter what she thought of Chairman Powell's latest speech about the new procedures and that interest rates might stay lower for 6 months rather than 12 months. And they will look at you like, what the hell are you talking about? And there's, historically, again, so I come from the 1970s. When inflation really got going in 1976, President Ford had this campaign, Whip Inflation Now. There's little buttons, WIN, Whip Inflation Now. They gave lots of speeches about how nice it would be if inflation would go down. Earlier in the 70s, they gave all sorts of speeches. Oh, it's transitory and union pressures, and we have the tools, and we think inflation should go down. Inflation did whatever it wanted to do. So I'm going on. I just think it's hilarious that they think the real question is, do their actions have any effect? But that now they think that their speeches alone have profound effects on bond markets. Yeah, bond markets hang on every word the central bankers say. But that the guy setting the price of ice cream out in Fresno pays any attention at all to central banker speeches, I think, is a hilarious conceit.
It's an interesting thought experiment as to what needs to be done to actually get the Fed to be much more in touch with Central America, Midwest, wherever. And there has been obviously different branches of the Fed around the country to hopefully capture that. But then if you look within the Fed, it's still very much an academic-driven Fed. It doesn't look to the types of people that are running business, so the people that actually see on the ground how things are operating.
Well, to their credit, they do. I mean, Powell is amazingly good at this. They do enormous amounts of listening. They did a whole listening tour for a year before putting in this new policy proposal. The point of regional Feds is to listen to local business people. They do listen to lots and lots of complaining about everybody who wants interest rates lower who's borrowing and everyone who wants interest rates higher who's saving. But you're right. The central banks in general, the Fed actually is pretty good in this. But there is this sort of bubble where they talk to each other and convince themselves of stuff that, if they talked a little more outside the bubble, they would, other central banks are worse. The sort of, the European central bank lives in this. I know the academics there, they're all perfectly fine academics, but the policy people talk this little language of the language of Davos among each other and talk themselves into all sorts of things.
We've got to switch back to some of your comments around climate change and inequality and so forth. And it seems like a bit of a real struggle for the central banks to actually start to do something in this space, particularly given the amount of debt they've got before. Their solution always seems to be, how can we add more liquidity to the system? How can we add more funding to things? Ultimately, climate change, you could throw unlimited sources amount of money at things and maybe not achieve anything, actually, if they don't address the underlying growth problems that we have in the.
I want to clarify. I am not a climate denier. I'm all for climate change is a problem, and we ought to do something about that problem. And we as a nation ought to do something about that problem. And I'm all for actual science on this. So we should be allowed to say the fact out loud that nuclear power doesn't emit any carbon, and that carbon capture and sequestration actually does remove carbon, and that it doesn't matter where on the planet the solar cells are built. If solar cells are built in China and shipped to us, those solar cells remove the same amount of carbon as if they're made by nice union workers in Pittsburgh, Pennsylvania at 3 times the cost. The problem is that central banks have no business at all doing this. So what's going on now is central banks are getting into the business, and they're asking banks and businesses to disclose climate risks, which is preposterous. There is no climate risk to the banking system. The climate is not going to change suddenly, unexpectedly, drastically in the next 10 years in a way that could imperil the financial system. That is just an absolute falsehood myth. used to justify, since we can't get these things through Congress, let's use the financial system to deny money to fossil fuels and to subsidize whatever the party in power right now wants to do. Forget cost benefit analysis. If they want to do electric car stations in the middle of Wyoming, the Fed will subsidize. The European Central Bank is already buying green bonds. It says they're underpriced. That means they are printing money to subsidize people's pet projects. They have no competence and they have no mandate to do this kind of thing. So I'm all for climate. I'm against this because I think climate's really important. And turning it into a underhanded boondoggle run by central banks who are allocating credit to whatever pet projects of politicians are, that's not going to do anything for the climate. It's going to waste a ton of money. And when people find out about it, they're going to be up in arms. And in the meantime, we're not doing the things we need to do about climate. And it's also poisoning financial regulation. They are demanding that banks make up stories that are false. Because you're a bank. And the central bank comes to you and says, well, we want you to disclose your climate risks. And you say, there is no climate risk here. No, we want you to disclose your climate risk because the climate's so important. You get the message, right? Cook me a set of books that says there's some climate risk and we're doing something about it. And we're, by the way, not going to invest in Exxon anymore. Well, once you cook the books, you've cooked the books. And genuine financial regulation, which is we're still in danger of financial crisis. We started to mention a sovereign debt crisis. No one's willing to talk. The next financial crisis could well be a sovereign debt crisis. Well, what's your exposure to sovereigns? There's something worth asking. What's your exposure to if there's another pandemic? There's something worth asking. What's your if China invades Taiwan? What's going to happen to your business? There's something they ought to be asking. But if you cook the books for climate change, to justify a pre-existing set of climate boondoggles, then financial regulation goes out the window, climate goes out the window, and even genuine environmental problems, of which we have plenty, are forgotten. So climate's important. It's just central banks ought to do what central banks ought to do, and the DMV shouldn't be in charge of climate change. We've got a perfectly good Environmental Protection Agency. We got Congress, administration. Let's pass a sensible science-based climate policy. Yes, but don't sneak it in through central banks.
Well, they're sneaking it in, not just through central banks, but through all the asset owners, asset allocators, asset management. It's becoming a huge cost to everyone, all this reporting.
Well, that's, if they're honest, that's fine. If an asset manager wants to sell an ESG product or a climate-friendly product or whatever, and if people want to suffer lower rates of return to invest in things that they believe in socially, great for them. Now, what's going on, however, is we're all being forced to do it, and so that the Securities and Exchange Commission is now forcing this kind of thing through. So that's the part to object to. Not that they're doing it and selling it to people who want it.
Let's move to the other conversation that has become very prominent within central banks, and that's sort of trying to address inequality. Social justice as well, racial justice. They're really trying to do everything. I'm really curious as to how you can actually do that without disadvantage one other part of the group, the community.
I don't think central banks are not going to be in the business of transferring wealth from one to another. But I do think that a lot of these efforts will lead to, the unintended consequences here are, for one, to competition. So, what can a central bank do about these things? Well, they can keep interest rates really low, and that might do something. They also have a long history of forcing banks to make unprofitable loans. We're going to repeat 2008. 2006, there was a Community Reinvestment Act. There was all sorts of pressure from bank regulators for banks to lend money to people who, it turned out, couldn't afford the loans. And then they destroyed a generation of underprivileged Black other people who took out big subsidized loans to buy houses. And then things went bad and they lost the house and they lost the loan. So we're going to repeat that, which is counterproductive to the people. I wouldn't want to sell objection to this stuff on, well, you're going to be hurting, you're going to be taking money from white people and giving it to Black. That's not what's going to happen. But you're going to hurt the people that you want to help through this kind of thing. You're going to create boondoggles. It's going to be politicized. That our Fed has already forced banks to give money to community action groups who kind of tend to support one political party rather than another. And, they're going to regulate banks internally, force them to how they do stuff, run diversity and inclusion and so forth. It's just not a business that central banks really, justice issues are important, but that's not what essential. Let me tell you my most fundamental problem. It means a central bank is just part of a political administration. There's fine that there's political thing. The Treasury Department, you elect the new president. The president appoints a Department of the Treasury. The Treasury Department goes out on a political agenda. The central banks are becoming just one more agency of that sort. Now, but central banks have great independence. And in a democracy, you only get great independence if you respect limits on your power. So if you go out and forcibly push one political party's political agenda, favor its constituents, give money to people who support that party, not the other party, do things that party wants, you cannot remain independent. So what we're going to lose out of this is I think a great achievement of the last 50 years is independent central banks who are not just at the whim of the administration. But you can only stay independent if you stick to your knitting. If you don't stick to your knitting, you just become one more. If you're an independent political agency, well, you're doing your own. We don't have that in democracies. We're just not allowed to go off and do something very political, transfer money from one to another, subsidize this, subsidize that. So you become part of the party in power, and then you have to lose your independence. And that's sad. If the money printing just becomes, we put the money printing aside. In a democracy, we don't just 51%, you do everything. You put certain things aside. The Supreme Court is supposed to be, somewhat removed from the passions of the day. The central bank was supposed to be somewhat removed from the passions of the day. You decide on a kind of bipartisan basis, look, we're not going to let interest rates, printing money, and telling the banks who to lend to. That's not going to be something that we switch every 4 years who the banks give money to, and it stays independent. Well, that's on its way out.
I'm curious then to get your views on whether you should have past central bank chairs moving to the Treasury. Should we have limits between that? A 5-year limit or a ban potentially on that?
No, I don't think so. And I mean, Janet Yellen is a remarkable person, and she's very competent. And I actually, central banks have to work with treasuries in the sense that money and bonds are kind of the same thing. And from an academic point of view, monetary and fiscal policy are not separate. They have to be coordinated. So I don't see any problem with that at all. And I think Janet Yellen in particular has been quite good about being an independent central banker when she was a central banker, and being a loyal. I disagree with half of what she's doing, but she's certainly doing a good job as a Democratic Treasury Secretary, and her knowledge of finance. We've had Treasury Secretaries who didn't really understand how checking accounts worked. So her knowledge of the financial system, I think, comes in handy. So I think honorable people can serve in all sorts of different roles and not need rules against that sort of thing.
So final question. Let's go back to your book, Asset Pricing, that you wrote probably almost 20 years ago now.
Yeah.
It could be 20 years this year, if I'm not mistaken.
Still needs a revision.
What would you change, or what would you add if there's a revision coming in the works?
Oh my gosh, all sorts of stuff. Unfortunately, right now I'm working on a new book, The Fiscal Theory of the Price Level, but maybe I'll go back to asset pricing. I still think it's a good book, but it bears the idiosyncrasies of its time. What has changed? I now understand continuous time a lot better than I did, so I would do a better job of that. There's a draft chapter on portfolio theory, which was supposed to make it in and never did. But of course, it's a book about asset pricing. It doesn't do anything about portfolio theory. That's a part I think we got things to do. There's been a big new effort since 2008. Asset pricing is no longer about behavioralists versus rationalists. It's the interesting new thing is let's call them institutional finance, the study of financial frictions. Now, it's not clear whether it's the icing on the cake or whether it's the cake, but it's certainly important understanding of institutional frictions that we didn't have when I wrote the book. So but I'll let Marcus Brunemeyer or other people doing that stuff right. Maybe they should write their own book, and I should get back to the fiscal theory of the price level.
Well, that's been a fantastic conversation. Thank you very much for your time today, John.
You're welcome. It's been a pleasure.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Connexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.